Good morning, good afternoon, good evening from wherever you're watching me from. Welcome everybody and welcome back to the channel. I'm Setowas and I'm going to be your trainer for this entire series. So if you're here, you're welcome. In the last previous video, I explained to you how we are going to use correlation to trade and have an edge in the market as day traders. And this is the video. So if you're here, please pay attention to the end of the video and make sure you listen to every word I say. Keep it in your mind, and anytime you're trading, practice the same so that you'll be able to get higher probability trades to take. If you are a day trader, if you're a foreign day trader and you're only looking at one pair at a time, you're actually missing a huge edge. Because what if you could confirm your trades or improve your timing or avoid bad setups just by maybe watching two or more pairs together to have a great edge? And in this video, I'm going to break down the forex pair correlation and more importantly, how you can use it as a day trader to get cleaner entries, stronger confirmations, and maybe better overall decision making. So if you're here for the first time, kindly subscribe to my channel and hit the like button and pay attention to this lecture, and let's begin. If you've done that, then thank you very much. Okay, so let's begin with the first concept. What is correlation? What actually is correlation? And guys, this concept, if you're learning a new concept, is a little technical, so please don't get bored. Listen to what I'm going to say, okay, and follow me. What actually is correlation? In currency trading, when you say correlation, it means two currency pairs moving in relation to each other. So what does it actually mean? Let's name any currency pair at all. Any currency pair. Let's say Euro JPY, AUR, and JPY, JPY. Let's say this is a pair, and this pair is moving in this direction. And there is another pair which also move in similar or same direction at the same time, considering the same time. Then we see that this pair and that pair are correlated. So let's say pair A and then pair B, pair AC and pair BC. They move in the same direction, which means they are correlated. That is what it means in simple terms. So correlation means two currency pairs moving in relation with each other. And there are two types of correlation. We have positive correlation, then we have negative correlation. What does it mean? Let's assume that pair AB with the same scenario, right? Let me clean these things away. With the same scenario, let's assume that pair AB is moving upwards, the upwards direction. So this is A, B, pair AB. Then we have another pair at the same time moving in the same timing in the same direction. This is pair BC. Then we see that this pair and this pair are negatively correlated because this one is moving upwards, but at the same time, instead of this particular pair to also move in the same direction, it's moving downwards. But if they are moving at the same direction at the same time, then they are positively correlated. If they are moving downwards, they are negatively correlated. You get the difference? So positive correlated pair moves in the same direction considering the time. Guys, the factor is what? The factor is time. Considering the time. Negative correlated pairs move in the opposite direction considering the same time. That's what is meant by correlation. And what are some of the most correlated pairs? We have example, we have Euro USD and Pound USD. These pairs are mostly correlated. Why? Because the USD is in both of them. We have USD here and we have USD here. It means, let's assume that Euro USD is trending upwards. What does it mean for Euro USD to trend upwards? It means the USD is weak and the Euro is strong. That is why this pair is trending upwards. It means since the USD is weak, the same USD here is also weak. The same USD which is here. So Pound USD is also going to trend upwards because the USD is going to be weak in both of them. But it's not actually always the same. Sometimes the USD can be weak here in relation to the euro, but sometimes the USD can be also stronger in relation to the pound. But most of the time, the reason why they are positively correlated is because the euro and the pound, they have similar economy. Because the European economy is almost similar to the British economy. So anytime anytime the euro is strong, it's likely that the pound is going to be strong. That's against the USD. That's why they are highly positively correlated. If a pair is negatively correlated, it means that, let's say the Euro USD and the USD switch. What does it mean? It has both USD in them. But in this scenario, here, the Euro is the base currency, the USD is the code currency. But here, the USD is rather the base currency here, and the switch is the code currency. So let's assume that the USD is weak here. It's weak here, which means likely the USD is also going to be weak here. So if the USD is weak in this euro pair, what does it mean? It means this pair is going to trend upwards because the euro is rather strong. So that's the base currency. If the base currency is strong, it rather goes upwards. Now, here, the base currency is rather USD, which means the USD is going to be weak. If the USD is the base currency is weak, the currency pair trends downwards. So the Euro USD pair and the USD switch pair are negatively correlated, while the pound USD and the Euro USD are positively correlated. Now, do you understand the whole concept? Okay, so why does this happen? Because they share similar currencies. That's why most of the time it happens. But is it always going to be like this? No, but most of the time, about 80% of the time, since they share the same currency, they move similar in direction with each other. So now that you understand the concept of correlation itself, let's dive more deeper and see how we can apply this concept. So the question is, as day traders, why does correlation actually matter to us? Why should we worry about correlation? As day traders, you're not just looking for entries, you're actually looking for high probability setups. Because if you don't have high probability setups, it means you're not going to have a lot of winning trades. It means your winning edge will be low. So you must have high probability setup. This is when correlation helps you. So correlation helps us as day traders in three powerful ways. One, correlation helps us in trade confirmation. And what does it mean to use correlation to confirm your trade? Let's assume that you want to buy the Euro USD. So Euro USD is trending upwards, up, retrace, up, retrace, up. You want to find a way to enter the market somewhere, either here, there, or there, anywhere at all. You see, on the graph, the market does not look perfect as we see like this, right? But on sketches, it looks as perfect as this. So let's assume that you want to buy Euro USD. Now, you have to confirm to see whether Euro USD is actually trending or it's just a fake trend. And to do that, you confirm with the partner. And the partner for Euro USD, the most positively correlated pair is the pound USD. So the pound USD, also open your chart. Pound USD, check if pound USD is also trending in the same direction upwards, then it means that both of them are moving together. It gives you confirmation that now the market is actually trending properly, trending upwards. Have you seen? If you open Euro USD and Euro USD is trending upwards, but the pound USD is rather ranging like that, it gives you a red flag. That be careful, because both pairs are not correlating. They are not correlating, which they are actually supposed to do. They are not moving in the same direction, so it gives you a red flag to wait for the right timing for them all to move together. So correlating helps in confirming our trades, our trends, to make sure that we are trading actually the best trend. Let me tell you a secret. No matter the strategy you're going to learn, either the bounce strategy, either the breakout strategy, either Fibonacci strategy, either engulfing strategy, no matter the strategy you're going to learn, if you trade a strategy in a wrong environment, wrong market environment, your strategies are not going to work. They are going to give you a lot of losing trades, and your edge will be low. That is why it's always best. You see, the difference between the amateur trader or the unprofessional trader and the professional trader who makes this a living out of this is because they don't just go to their chart and begin trading. Like the amateurs will just go to their chart and begin just buying and selling. No, professional traders don't do that. You see, so the analysis is not made on the charts. Most of the analysis are made outside the chart. The question is, Is the currency pair in the correct mood? Is it in the right mood to trade your strategies? Before you think of even entering the market, either somewhere, anywhere you want to enter, ask yourself, is the environment safe for your strategies? That's the secret behind all successful traders. So if you've been trading for some time and you are still not profitable, it obviously means that you are not actually doing proper analysis. You are just going straight to the charts and you're just trading. So correlation helps us to confirm our trends, to make sure that the market is a similar environment. That's number one. You get it? Okay. Correlation also helps us in timing our entries. What does it mean? So sometimes, let's assume that you want to trade the same Euro USD, right? Or Euro Pound, and you realize that one of them has broken a structure. So let's say there is a trend here. Let's say there's a structure here. You realize that you want to trade the Euro Pound. You want to trade the Pound USD. The Pound USD has broken a structure. So you want to find a way to enter and join the market upwards. But for you to tell whether it is a fake break, so the market will not reverse and come back, you have to confirm it with the next partner. The partner is the Euro USD. So you wait, check the Euro USD. If the Euro USD has also moved and broken a very great support, such that both of them will be hitting great support, then it means your stop loss is safe and you can now take the trade, either in the Euro USD or the Pound USD. So confirmation helps us in timing our entries. You see, the strategy, the setup you're going to trade is just going to help you to know where to enter and how to enter. But for the trend and for the timing, you need correlation to tell you to do that. Sometimes too, you realize that the market is about to break. So sometimes you'll be able to also enter earlier. Since let's say you want to trade the Euro USD, and mostly the Euro rather follows the Pound most of the time. So let's say that the Pound has made a move, broken a structure. Then if you want to take a huge risk, you can also buy immediately at the Euro, the other partner. So I don't lose the entry. Then you know that definitely since one has moved, the other will also move the same direction. But I don't advise that unless you know what you're doing. Most of the time, wait for both of them to break a good structure before you think of buying or selling your trade. Do you get it? Okay. Correlation also helps us to spot divergence opportunity. What does it mean, divergence? And you see, divergence is one of the most powerful concepts if you understand it and you can use it well. It's actually going to help you. It is used to create reversals. So let's say, for instance, Euro USD is going upwards. So Euro USD, up move, retrace, up move, retrace, up move, retrace. Now, the Pound USD is going downwards. Up move, retrace, up, down, retrace, down. You see, this shows that there is a divergence. It means there's a divergence in the market. What does it mean? Because you know that the Euro USD and the Pound USD are supposed to actually move together. But since they are moving in the opposite direction, it means one of them is going to actually reverse. One is going to reverse actually, because they all have to come back in the same line because they have similar economy. The Euro and the Pound has similar economy. So they must definitely reverse. One of them is going to reverse. Either the Euro is going to reverse downwards to join the Pound, or the Pound is going to reverse upwards to join the Euro. So you watch for divergence opportunity. This is what we call divergence. You watch for a good timing where you think that, okay, this is the pair that's rather going to reverse upwards, or this is the pair that's rather going to reverse downwards. So it tells you the weakness in the move. It tells you there's going to be a possible reversal, and going to tell you whether it's going to be a fake breakout or not. So as a day trader, it helps you to avoid bad trades. Even looking at the reversal setups, you realize, okay, no, this is not the right time for me to buy or sell reversals, which means the correlation is going to help you to do that. You get it? So for very simple rules to follow, always before you take a trade, make sure that you check the most correlated pairs before you take the trade. So you know that on this channel, we trade with a system, and the first system is using the CSM. If you don't know the CSM, guys, then it means you're a new person here. The CSM is a currency strength meter, or the currency strength matrix. These are a very best indicator we use here on this channel. If you don't know how to use it, check some of my previous videos and you know how to use it, okay? So you know that the first thing we have to check is the CSM, to check whether our currencies, we are looking for currencies which are strong versus currencies which are weak. Then we merge them. That's the first thing. The second thing is to use Fibonacci levels. To draw our Fibonacci levels. Then the next system we use is to use correlation to trade. So what are some of the most correlated pairs? The question is, how do you know which pairs are correlated? Let's take a look at some most common positive correlated pairs. Keep them in your mind by heart, because you must know all these things, okay, in your head before you even begin to trade. Guys, if you're not learning as a day trader, please stop trading and learn. Do not trade if you've not learned much, guys. I'm begging you, okay? Do not trade if you've not learned much. So stop trading, learn, guys. There are a lot of information online, a lot of information on Google. Guys, learn before you think of trading. So let's look at some positively correlated pairs and how you're going to keep them in your mind. The first one I've discussed already is the Euro USD and the Pound USD. Why? Because they all have the USD as their code currencies. And Euro and Pound, they share very high positive correlation because they share similar economy. The Europe and the UK share similar economy. So when the Euro is strong, it's likely that the Pound too is going to be strong. Okay. Now, the next pair that are highly correlated is the AUD USD and then NZD USD. Why are they positively correlated? Because they all have the USD as their code currencies. But why would the AUD and the NZD also move together? This is because they are called the commodity block, which means they are similar. The AUD and the New Zealand, this is New Zealand dollar, and we have the Australian dollar. They move together because they have similar agriculture and mining based economies. Due to this, when the AUD currency is going upwards, it's likely that the NZD too will go upward because they share similar agriculture and mining based economy. So their commodities are similar. Okay, so first Euro USD and Pound USD. Second, AUD USD and NZD USD. Guys, please take a pen and write these things down. Okay, write them down so that you master them by heart in your head. Okay, then we have the Euro JPY and the Pound Yen. See the Euro guy again and the Pound, which means always the Euro moves with the Pound. So the Euro with the Yen and the Pound with the Yen. Why are they positively correlated? Because they are heavily influenced by market risk sentiment, which means it's like a safe haven. If somebody wants to hedge their currency or their asset, they hedge it in the Euro Pound or the Euro the Yen, the Pound Yen, because these ones they are actually the safest place. You won't get huge spikes and unnecessary spikes in this particular currency pair, which means they are actually controlled properly. So the Euro JPY, which is the Euro Yen, and the Pound Yen are considered safe haven assets where people invest if they want to hedge their currencies. And to hedge means that you don't want your currency to lose its value. So let's assume that for easy calculation, you have $50,000. Let's say 500 million. Let me just make it $500 million. Now, you don't want this money to lose its value. Neither you also want to use the money for anything. So what you do is that if you put this money in a bank account over a period of 10 years, the money is going to devalue. The value of the 500,000 is not going to be the same as 500,000 10 years later. Let's say 500,000 can buy 5 mansions. I'm just giving an example. Okay, can buy five houses or 5 mansions. Wow, this is my house. Okay, can buy 5 mansions. By 10 years time, the same $500,000 can buy only one mansion, which means the money, the $500 is still 500. The 500,000 is still the same 500,000, but it has lost its value to one. It can buy only one of the assets. This is where people prefer to hedge. HEDGE. To hedge. To hedge means that you put this amount instead of putting it in a bank. Instead of putting this in a bank, you buy an asset and hold it, which means you buy and sell at the same time. So let's say the same $500 million or the $500,000 is still in the same asset. 10 years time, while the asset is going and improving, the same $500,000 or 500 million will keep improving, increasing in value. So if let's say 10 years time, you want to buy 5 ounces, the same 10 years time you can buy 5 ounces. This is what is called hedging, and this is a topic on its own, but we don't need to know. I'm just trying to explain to you, those who are not aware. That's why most people prefer to put their money in the euro yen and the pound yen. This is for long-term traders, okay? Long-term, not day traders, long-term traders. So I'm just explaining the concept to you so that you have an idea of what it means. The net positive correlated pair is the USD with the CAD. So USD CAD and oil prices. Why? Because when these two pair, oil is not a currency though, but they're highly correlated. Because the USD and the Canadian dollar is highly correlated with the oil. When oil goes up, the USD CAD also goes up because the USD is highly correlated with the oil. Okay, so these are positive correlated pairs. Please, have you written them down? Let me clean all this so you can write them properly, guys. Write them. Have you written them down? Have you written all of them down? Okay, let's move on. Okay, so now let's look at some of the negative correlated pairs, which is you have the Euro USD and the USD switch, as I've already explained, because here the USD is the quote currency, but here the USD is the base currency, which means if the Euro USD, if the Euro is strong and the Euro is going upwards, since the USD is weak, is the quote currency, definitely. The USD here being the base currency here is going to go downwards. That's negative correlation. You understand? Then you have the Euro, the USD CAD and the AUD USD. See the same scenario. Here the USD is a base currency. Here the USD is a quote currency. So when one is strong and going upwards, the other pair will actually be pulling the other side downwards. This is as simple as that. So these are all negative correlated pairs. Just keep them in your head, and then you need them, guys. You need them. So now, guys, let's see correlation in action. How we use correlation to trade. Let's go to our chart. Let's, for instance, open any chart at all. As we've learned about Euro USD and the Pound USD. Let's see if they're actually correlated. So luckily, it's already here. If you don't have Euro USD and Pound USD, just go to File, New Chart, and open your chart. Okay, open any chart you want to open. Okay, so now you could see that. Let's move to any day at all. Any day. Let's assuming that. Okay, here is where 9th January, right? 9th January. Let's go to the Pound USD. 9th January. 9th January, 9th January, 9th January. Okay, so see the pair. This is the Pound USD. Are you watching? And this is the Euro USD. Can you see any difference? You see they look similar. Have you seen? They look similar. Good. This is what we call highly positive correlated pairs. So how do we use this to trade? Now, I explained in the previous video that you're going to use Fibonacci and correlation. So let's say this was 9th January and this was the market previous day. Assuming that this market has not played, let's assume this side, which is 12th, has not played. So 9th January has played. For us to trade the 12th January, what do? We have to draw our Fibonacci levels from the highest level of the day, the previous day, to the lowest level of the previous day. And I've already explained to you that this Fibonacci level is customized, right? In the previous video. So if you don't watch, you can go and watch, okay? So we drag them all the way to the next day to see which areas we have to put an eye on to watch. Have you seen? To put an eye on to watch. The same thing. We go to the Pound USD on the 9th. You see similar. We drag from the highest point to the lowest point of the previous day. Then we drag them. Now, this is going to give an idea of where to watch the next day. Let's begin. Where did the market begin? The market began exactly here. So you could see that on my money flow index, this indicator is called money flow index. It shows how volume. It shows how there's a lot. It shows the time when there's a lot of push in the market. So you see that from the beginning of the market, see the money flow index had a long push. I'm going to also explain this kind of indicators to you later and how you're going to trade with them. But for now, let's focus on this one. This is where the market began. These are period separators. If you don't know them, this is period separator and this is also period separator, separating the day. So this is 1 day. Here is 1 day, and here is also another full day. But assuming that this day has not played, the Fibonacci levels are going to help us to predict what may happen in the next day. you could see that when the market opened, the first time the market had an encounter with the level was around 12:45, 1 o'clock. The same way when you go to the Euro USD, you realize that around 12:45 and 1 o'clock, see, this is 1 o'clock, the market was also hitting the same similar zone. So you see, it hit and now it reversed to the central Fibonacci levels. The same way, the pound USD also hit around the same time. It hit and also reversed to the central Fibonacci level. So assuming you want to take a trade, since both of them are hitting the same area, they are hitting the same area, now you can take your trade. You can take your buy here, you can buy, because you know that they are all hitting the same area. Your stop loss somewhere behind, take profit target at the central Fibonacci level. Do not cross the central. Okay, don't cross this point. Always take profit target should be somewhere here or somewhere just there. But your risk reward is 1 to 2. So if you know that if you put your stop loss, let's say your entry is here, without any confirmation, your entry is here and your stop loss is somewhere here, then your take profit target should be as twice as the stop loss, which is somewhere around this line. So your take profit target should be here. Then you take your profit, because both the currency pairs are all hitting a very strong resistance zone. See that after both of them broke out of the central Fibonacci levels, you see, now the Fibonacci level became a strong resistance zone. Look at the Euro too the same way. After it broke out of the central Fibonacci level, the market did not return again. It became a strong support and it was able to break through. So it reached the last button of the Fibonacci level. Now, in a pound USD, the market was able to break through the central Fibonacci level and also trending upwards. So it also reached and passed the last line of the Fibonacci level. So you see, this is how correlation is very, very important. So in the next video, I'm going to teach you how to use the strategy, how to time the best entries, and how you're going to be good combining Fibonacci with correlation with the currency trend meter to have a greater edge. This video lecture is taking long, so I'm going to end it here. And if you enjoyed the video, don't forget to subscribe and hit the like button. I'm Setowas, and I was your trainer for this video series. Please, my advice is that listen to my advice, please. If you've not learned much, do not trade the market. Okay, please, the market is always random and it's always changing. It is not as simple as you guys see it. If the market was as simple as people show you on YouTube, they would have all been rich, guys. Everybody in the world would have been rich and the market would have existed. So having knowledge is everything. That is the only way you can dominate the market. And as I explained at that time, in trading, let me clean all this, guys. As I explained the other time, in trading, about only 90%, about only 10% are profitable. And 90% are not profitable. So this 10%, where do they get their profit from? Trading is 50-50. So whilst you are winning, you are losing to somebody. So this 90% people who doesn't have idea of what they are doing, anytime they lose and their profit goes to the 10% who are profitable. So it's about the master eats the newbies. If you have mastered trading, then you are going to be part of the top 10%. But if not mastered trading and you are just a beginner and you think it's just as simple as, oh, the guy showed you on YouTube that when it hits this particular zone, you just sell. So you do that several times. You realize that it is not working, guys. It is not working most of the time. It means you are not analyzing the market well. You are just using simple information, and trading is not simple. If you are going to join the 90%, guys, knowledge is everything. Keep learning and keep doing research and keep testing. Like this concept I have explained to you, for instance, you have to take your chart, go to your chart and apply the same concept and test and to become familiar with it. All the concept I've explained, correlation, guys, don't just close your phone or close your laptop. Just keep searching, keep learning. That's the only way you can make it profitable, because trading is one of the most profitable business. But if you don't have knowledge, it's going to be one of the most riskiest business. Okay, so guys, I'm tired already. I hope you've listened to my advice, and go and learn, and see you next time. Okay.